say this is an interesting conversation, and when I hear some of the testimony, I do detect a paternalistic hostility to what I consider to be the foundation of our free markets, and that foundation is the freedom to take risk. It's paternalistic because I hear an elitist sentiment that only sophisticated, only highly educated or institutional investors know what they're doing. And government should intervene to restrict commission-free trading to protect retail investors from themselves. That government knows best, and retail investors are simply not smart enough to allocate their own capital for themselves. I think there's hostility because it sounds like some of the witnesses want to pull risk-taking completely out of the system. Let's be honest, that is code for doing away with free market capitalism. Now, this is the second of what is expected to be a 3-hearing episode on this topic. The majority has concocted a series of villains in this saga. The first, it was the hedge funds who supposedly collaborated and colluded with Robinhood. Then it was the practice of short selling. Then it was payment for order flow. Now it's the so-called gamification of investing, as if creating user-friendly platforms that attract wider swaths of investors is a bad thing. Provided that no securities laws are broken or consumer protections are compromised, it's not the role of Congress or regulators to dictate the constructs of a user experience. If investors like the platform, it will succeed. If they don't, it won't. Mr. Pivavar, how might additional poorly tailored regulations on financial technology like app-based investment platforms slow the expansion of retail investor participation in the capital markets?
Yes, thank you, Congressman Barr, for that question. One of the concerns about slowing down access for retail investors is the equitable access. What disparate impact will it have on low-income households who are already put at a disadvantage from the accredited investor definition? And if I may just address, I think there's a straw man argument brought up by Congressman Hines. There's not this world where people are putting all their money into a Robinhood app and trading all of their portfolio all the time, or they're putting all their money into a Vanguard index fund. What we see is that a lot of investors are very sophisticated. They put some of their money into passive index funds, low cost, and then take a little bit of it and try to generate a little bit of alpha and see how good they are at it. And some win.
Mr. Pivavar, that's a very good point, and I think we shortchange the intelligence of some of these retail investors when we just assume that they are not diversified. Let me ask you another question about payment for order flow. Would restrictions on payment for order flow or an outright ban on payment for order flow impact price improvement for retail investors? And if so, what would that impact be?
Well, so the first likely event we're going to see is that we're going to return to commission-based trading. Free commission trading would go away. Again, that would have different impact. And the second point I would make is that if we're back into a world where there's another conflict of interest, and that's the churning of accounts in order to generate commissions, right? So it's been said in the testimony that there's an incentive to generate revenue by more trading for payment for order flow. That same incentive exists in a world where you have commission-based trading. And in a prior part of my career, I actually worked as an expert witness on behalf of plaintiffs who were arbitrating against in broker customer disputes in a FINRA arbitration for churning accounts. And so, again, that's another thing that just has to be monitored for compliance and enforced.
And I don't have time to ask the question to Mr. Grujic again, but I think his point about forcing a combination of retail and institutional flow will have a negative impact on price improvement for retail investors. And I think that stands repeating and an unintentional consequence of excessive restrictions on PFOP. Final question, Mr. Pivavar. Mr. Kelleher and some of the other witnesses have argued today that existing best execution requirements do not sufficiently address what they consider to be conflicts of interest associated with payment for order flow. Do you agree? And has payment for order flow in any way canceled broker-dealers' duties to route customer orders to achieve best execution?
So the answer to your last question is no, they have not canceled that. What I've said in my testimony is that, of course, the SEC should revisit its best execution rules in light of zero commission trading. Best execution is a multi-factor, multi-dimensional thing that the SEC looks at. And so markets change, markets evolve, technology evolves. Of course, the SEC has to revisit that. But there's been no diminishing of it. In fact, the SEC vigorously enforces the best execution rule.
Thank you. My time has expired. I yield.